look at utilizing your money actually while it's invested. Okay? So we take the accounts that we currently talked about that are tax-free and then also pay you a rate of return that's really good but has no risk to it whatsoever. Now, the other thing that if you've listened to my webinars before that you've learned about is that the IRS, one of the few things they can't tax is interest on loans. So what if I invested the money into one of these accounts and I could still actually utilize it while taking a loan out that is basically 0%? So, for instance, I'm going to take a step backwards here. I'm into cars. I really like Jeeps, and I've been buying Jeeps the last few years and some Toyota trucks and different things. So we've all been told that you should buy everything cash, right? Well, financially speaking, that's wrong. If you think about it, if that was true, companies and banks, they would never owe any debt if possible. But most of them have debt because if they borrow money at 5% and they're making 12% with it, or 10%, or whatever it is, then they're making a good profit. So that's why they continue to have debt, because they make more with the money that they're borrowing than if they paid it off. Okay? So let's take a personal example here. I told you I'm into Jeeps. This is an old picture, but this is one of the Jeeps I built years ago. Let's say I bought this Jeep for $20,000 cash, just for sake of example. Okay? Now it obviously doesn't look like much, but this is a 4x4 Jeep, so the expense is where you can't see it. So if I buy this Jeep, which I used to do, for $20,000 cash, as soon as I put the $20,000, I give that to the person that I bought the Jeep from. How much money can I make with that $20,000 now that I spent it? Right, zero, nothing. Because I exchanged the $20,000 that I could have been making money with into an asset that's now depreciating. Number one, it's a car. But even if it was an appreciating asset or something that would make me money, the bottom line is I still got rid of that $20,000, and so I can't utilize that anymore. I just killed all the money-making potential of that cash or of that asset. So let's go back now. What if I invested, let's say, this money, let's say $30,000, and I invested it into one of these accounts that we've been talking about. Now, the accounts that I've been talking about pay a good 5 to 8%, and keep in mind that's tax-free. Okay, the bucket is probably a bad example, but I just that's what we're using for an investment. So just for visualization purposes, pretend that bucket's an investment. Tax-free investment pays you 5 to 8%. Now, again, it doesn't matter whether you've got 30,000 or 100,000 or millions, or again, a new client that I'm writing up, she's going to be putting in $200 a month. She just got her first job out of college. So, but the point is once you get $30,000 into this account, let's say that now I want to go and I want to buy a vehicle. Well, instead of having to go to the bank and paying them the interest and going through a credit check and all that kind of stuff, let's say I take a loan out from my own little bank or investment here that's tax-free for $20,000 in cash. Okay? Now, let's say I buy a vehicle with that is still earning, while my money is still earning percentage. In other words, I borrowed the $20,000 out to buy my Jeep here now, and I'm still making 5 to 8% on my money originally. Okay? Now, going one step further, I actually have a company now that this is just, kind of a hobby of mine, but it builds vehicles and Jeeps because my friends wanted some Jeeps. So let's say I buy one of these, and now let's say I don't have to pay it back. There's no obligation. But let's say I want to run it more like a bank or like a business, and I'm going to make payments back to myself with interest. Well, this is a business expense now. So now I can write off the interest that's going back to myself because I'm making payments on a business expense. So if you follow me here, now I've super funded my account because not only did I have the original money going in there, but now I have these additional payments and possibly interest if I want to pay that to myself. And that goes back in there and grows all tax-free. So instead of paying cash and killing all the money-making potential that you could have had with your money, we've actually created a minimum 6 assets instead. Number one, your money has been in that account, that bucket that I told you about, making 5 to 8% the entire time, instead of being dead or spent on something that doesn't make you any money. Okay? There is no risk of ever losing any of it. That's a huge guarantee, advantage right there, that you cannot lose any of it, just like we talked about in our previous webinar. It's also earning whatever interest rate it's earning that tax-free. So let's say you're making 5%. Well, that's like making another 30% on top of that 5%, because most Californians are in a federal tax bracket of 25% and a state tax bracket of 9%. So you're at 34%. That's like giving yourself an instant 34% raise, or whatever tax bracket that you're in. So you're making tax-free 5 to 8%. Now, if you make payments back to yourself by taking a loan and charging yourself interest instead of paying the bank interest like you normally would, you're actually even adding that back to your own account. And if it's through a business, or let's say you're utilizing this for a down payment for real estate or something like that, well, you can write that off. So just like, if you have a car business, I've got clients that buy and sell cars, or they have mechanic shops, or I have clients that are real estate tycoons. You can actually utilize that money out of this account and pay it back to yourself and write it off. So most importantly, at the end of all this, actually I'm going to save that for 1 second. Let's look at an illustration saying that if you did this for every 5 years when you buy a new car, instead of going through a bank, if you look up here at the top, let's say you put away $600 a month for 5 years, okay? You're going to have $35,955 of cash value built up. And then let's say that you borrow $30,000 out of this account to purchase a car. You don't make these $600 payments anymore. This would actually be great if you could keep making these payments as well if you wanted to. But let's say you didn't. Let's say all you ever did then was you purchase a car every 5 years, and you look up what your local bank payment would be with interest, and that's all you do is you pay that back to yourself. Okay? So at the end of 35 years here, well, actually at the end of the first 5 years, if you think about it, what do you normally have? Well, if you went through a bank, you normally would have a used car that's worth probably a 1/6 to 1/10 of what you paid for it. That it's not worth very much. All the principal for that car, or the cash that was to purchase it, has been given to the bank, and all of the interest that you've paid has also been captured by the bank. So again, at the end of it, you have a busted down old vehicle. So if we do your own bank situation like we've been talking about, you have the old busted down vehicle owned outright. You also have all of your principal back, okay, at the end of this 5-year term. You'll notice you have all your principal back, plus you have recaptured all of the interest back to yourself as well. And on top of that, you don't have to mess with the finance company. You have the pink slip to your car the entire time, which is actually kind of nice to have. You're not obligated to choose the insurance options and mandates that the finance company or the bank forces you to get on the car. So there's a lot more freedom that you have, and you can buy from private parties if you wanted to. You could buy a car that's a couple years old and save probably $10,000 off the purchase price versus having to go into a car dealership right now, because there is no private financing. It just doesn't exist. You have to buy a new car if you want to get financing. Or worse yet, a lot of people are leasing cars, and then you literally end up with no car at the end, no principal and no interest. You end up with nothing, and you have to start all over with another lease or car payment. So as you can see, this is very, very advantageous here. And if you go all the way down here, let's go all the way out to your 65. And keep in mind, this is not investing anything more like into your retirement. If you did that, this would be bounds better. But if you just did it and bought your car every 5 years with this plan and then made a payment back to your own little bank here, you would have recaptured $358,000 in lost principal and interest that you normally would have been giving to your local bank, car dealer, or whoever the finance company would be. Now, let's say at age 65, you want to retire. Besides the other retirement that you already have, you now that you have enough money stored up here that you would be getting $35,000 a year. Keep in mind, remember, this is tax-free. That's not gross. That's net. $35,000 for the rest of your life. And if you live to age 100 or 120, whatever, until you drop dead, you're going to get $35,000 a year tax-free. Plus, keep in mind that you'll also have money at the end, as this keeps building, to leave to your heirs. That's all tax-free as well whenever you pass on. So you're automatically leaving them a little bit of a lump sum as well. Okay? Now, I know there's a couple people that are on this call or on this webinar right now that are going, okay, well, I can do that with my 401k. I can borrow money out of it. Look, we're trying to do this under 5 minutes, so simple to say, no, you can't. If you could, you would have already been doing it, first of all. Yes, can you take a loan out of your 401k? Yes, and I don't have time to go into all the fallacies and the problems with that. But if you've ever taken a loan out of your 401k to pay for a house or debt or something, it most likely was a really bad move. Whenever I have clients ask me if they should do that, almost always no, you should not. Because taking a loan out of your 401k is completely different. There's many problems with that I can't go into right now. Not to mention, just number one off the top of my head, your 401k, IRA, or whatever other plan you're gonna borrow from, it's all tax money.